Good morning. Happy early afternoon for the East Coast folks. Welcome. Welcome, welcome. If anybody is inclined to drop something in the chat, I don't know what you have for breakfast, what's something you're looking forward to this weekend. We are opening up this session for Q&A at the end, so anything tax related, there will be a time for that at the end in the Q&A feature. Yeah, let's talk about breakfast. I just had Pete's cup of coffee. I probably need a second one right now. John had Cheerios. Good morning. Where is everybody calling from? Good afternoon, Susan. What'd you have for lunch? Toasty Cheez-Its. San Jose. I'm in San Francisco, Bay Area, represent. Susan, you had guac. That sounds delicious. Welcome, everybody. Thank you for joining. We've got a short agenda. We're going to spend the first 10 minutes today chatting through a couple slides, and then we're going to open it up for a live discussion. So anything tax related, financial related, self-employed related, please use the separate Q&A feature within Zoom. That way we can track your questions and get them answered. We'll give folks another minute or two. We've got almost 100 people on the call. Thanks for joining. Madeline in Hawaii. I hope you guys are doing okay over there. The tsunami watch has cleared, I think. That's great. Any handouts? There will be a recording of this session posted on YouTube, and then you'll also get it sent directly to your email. So you'll be able to see a whole recorded session later. All right, well, let's dig in. So today we are going to talk about the tax saving power of S Corps, how they work. When does it make sense to consider making the switch or adding the election? And then we're going to open it up for Q&A. So real quick, a little disclaimer here. This webinar is for educational purposes only. Nothing contained in this or any related webinar should be viewed as legal or tax advice. Always please consider consulting a professional if you need legal or tax advice in operating your freelance business. A quick little bit about me. I come from public accounting. I was in tax for 8 years. Did a little bit on the side here in my time at Collective, so I keep a pulse on the tax world. I've been with Collective for over 3 years, and I've held a couple of roles. And now I get the opportunity to lead these webinars and focus on education. So I'm really excited to hear your questions, and we'll dive in. So what is an S Corp, and why does it exist? So an S Corp is actually a tax status. It's not a legal business structure. You can't just form an S Corp. It's kind of a two-step process. So how does it start? First, you've got your legal status or your legal entity. So I live in California. I'd go to California's Secretary of State website and I would form a legal entity. This can be an LLC. If you've got a license, it could be a professional LLC, a stock corporation, professional stock corporation. Those are all the legal structures that you can form at the state level. It's what gives you a tax ID, your legal business name. It creates a layer of liability protection. And it's the foundation for adding the S Corp election tax status. So it's kind of a two-step process. What is an S Corp? It's going to start as a legal structure. And then secondly, you add on a tax status. So the tax status is how you tell the IRS you're going to report your business activity for tax purposes. Real quick background, when you're the only owner of an LLC, how are you taxed? It's pretty simple. The IRS calls it a disregarded entity. All that means is that your business and you as an individual are one taxable unit in the eyes of the IRS. So when you're the only owner of an LLC, your tax status is considered a sole proprietor or disregarded entity. What's the advantage of this? it's pretty simple for tax reporting. The downside is what we'll talk about. It's the opposite is why is an S Corp so advantageous? So the tax status is how you're taxed. So without an S Corp election, a single member LLC is reported as a disregarded entity. When you add the S Corp election, you're telling the IRS this business, this LLC or PLLC, is going to start reporting taxes differently. And this is what the S Corp is. It triggers the S Corp tax return, the need for more comprehensive bookkeeping. You have to pay yourself a salary. And with this tax status, there's an opportunity to potentially save on self-employment tax. So where does this S Corp come from? It's part of the tax code, subchapter S, and it was created by the IRS, and I can't remember when. Really, the intention was to encourage the growth of small business owners. Before the S Corp election existed, there were C Corps. There still are C Corps. But C Corps are the structure that have the true double taxation setup. They pay a corporate level tax. I think right now it's a 21% flat corporate tax rate. And then when the owners take distributions, you pay tax again. So before the existence of an S Corp, small business owners might have formed a C Corp and they were paying this double tax. The S Corp election gave small business owners the opportunity to pay themselves a reasonable salary and help alleviate some of the self-employment tax burden, and also give them an opportunity to not pay into that double taxation of the C Corp. So it is part of the tax code. I see some great questions coming into the Q&A. If you posted a question in the chat, please move it to the Q&A so we don't miss it. So the power of S Corps, how the tax savings work. So this is going to get a little gritty here, but we'll try to keep it high level. So what happens to your tax bill in either situation? Let's say you're a sole proprietor, you haven't formed any formal business structure yet, which is totally okay. Or if you form a single member LLC. In these two instances, the way you're taxed is as that disregarded entity, where everything gets reported on your personal tax return. If you've been set up like for your business in this way, it's a Schedule C. You're probably familiar with that tax form. It reports your income and deductions, and what's left over is profit. That profit is going to be subject in entirety to your personal income tax rate. That's determined by your filing status, so single, married, family, joint, and then your total household income. So you'll pay income tax on that entire profit. You'll also pay state level income tax if your state has income tax. And then, this is the kicker, you're also going to pay 15% self-employment tax on that business profit. That's made up of Medicare tax, 2.9%, and then the bulk of it is Social Security. So what's happening when you're set up as a disregarded entity? Assuming there's no other income, your business profit in entirety is subject to both income tax and self-employment tax. So you've got multiple layers of tax assessed on the entirety of your profit. So if you've been sticker shocked by a tax bill, maybe you just switched from regular employment to self-employment and you saw that tax bill, this is what's happening. So what does the S Corp let you do? Here on the left, we're going to walk through an example. This is someone who's set up as a sole proprietor or single member LLC. In this instance, this person has earned $160,000 of business profit. So this is after they've accounted for all their deductions. We focus on business profit because that's what's ultimately taxed. And so here on the left, this person's got $160,000 of profit. Without the S Corp election, that entire 160 is subject to the 15% self-employment tax, which is generating this almost $25,000 self-employment tax bill alone. This chart doesn't account for income tax. So here we've got $25,000 in self-employment tax. Here on the right, if this same individual elected S Corp status, same business profit, but of that, they've elected S Corp, now they're required to pay themselves what's called a reasonable salary. In this example, this person landed on $60,000. And so under the S Corp, now only the $60,000 rather than the $160 is subject to self-employment tax. And that's what's generating this almost $15,000 in self-employment tax that you just wouldn't pay if you have the S Corp election. Okay, so when does it make sense to switch and when it doesn't? Bear with me. Okay, so you've got a couple options. Not shown here is the sole proprietor stage, which is nothing's formed, and that's totally okay. The next phase would be forming a single member LLC, and the last phase would probably be the S Corp election, depending on your situation. So, how to formalize your business. Getting the LLC is what gives you the tax ID. It sets the foundation for S Corp. It creates that layer of liability protection. You don't have to hand out your social security number to clients. You've got a tax ID. So this structure might be best for you. Well, first of all, it's foundational. So in either instance, whether you stay in LLC or have an S Corp election in the future, the LLC tends to be the first step if you're going to formalize and continue to grow your business. So you'd likely need one regardless. An LLC may be best for you if your profit is under a certain threshold. This is not an IRS rule. This is really to consider, what does it cost me to do all the extra work as an S Corp? And so generally, if people are looking for a tax savings opportunity, 60,000 of profit is where the savings potential is more than the cost to do the extra administrative work. So if you're earning less than 60,000 of profit, maybe that savings advantage isn't there. Also, if you have another salaried role, and this is an arbitrary threshold, but if it's over six figures, 100,000, it can lessen the savings potential if you add an S Corp election. And there's some nuance and technicalities there that we can definitely talk about. But if you're looking for a savings opportunity, if either of those points are true, profits under 60K, or you have a high earning salary, the savings potential may be limited. So in that instance, maybe it's best to stay in LLC. Maybe you don't want to deal with all the extra administrative work of being an S Corp. So you want to keep compliance and formation simple. That can be an option for you. Maybe your side business is new. Maybe you're still testing the theory. You're not sure if you want to be self-employed. In that instance, maybe it doesn't make sense to trigger a new annual filing requirement for yourself with an S Corp while you're still testing the theory. Another instance is not all states are favorable when it comes to S Corps. I'm looking at, I think, Tennessee, New York City. Some states impose additional taxes when you're set up as an S Corp, and those taxes can offset the self-employment tax savings. So there are some instances where maybe your state compliance doesn't make it as advantageous to elect S Corp status. If you do, on the contrary, have more than 60,000 of profit, maybe you're committed, you've proven the concept, you've naturally gained a following, there's organic referral, you like it, that's an indicator that maybe you're going to be committed to self-employment for longer than a year, and the savings potential exists. If you're someone who wants to reduce self-employment tax, you felt the pain of those huge tax bills. If you're looking to just level up your business from an operational perspective, you've got big growth plans, small business loans on deck, and maybe you need consistent, clean financial statements. And then if you live in a state with favorable S Corp tax treatment, so there's relatively low administrative costs, maybe the S Corp level taxes in that state are relatively low. These are all factors to consider. I'll just say that every situation is unique, so it's worth a one-on-one conversation. Let these just be like earmarks or triggers to say, is it time for me to start having this conversation? And we've got 15 minutes for Q&A. So I see some chats. I'm going to turn off the screen, but before I do, please scan this QR code. It's going to pull up a screen for you to enter some information and book a call with one of our advisors. And you'll get a copy of this deck, but the discount code is Sun Savings. It's going to take $200 off at checkout if this feels like the right solution for you. Also, we've got related blog content that's going to support the subject matter of this webinar. So if you want more, not only will we have the recording sent to you, it'll be posted on YouTube, but there will be more information available in that email that you'll get at the end of the session. So before we dive in, if you haven't already, pull up your phone, scan this QR code. We'll drop the link as well in the chat. But I'm going to stop screen share and we're going to pivot over to Q&A. And let's see. We've got 16 questions and we are ready to go. And if you've got more, keep them coming. Okay, so anonymous attendee, for high W-2 earners, S Corp doesn't S Corp doesn't save self-employment tax more than 3%. Do you still see point of S Corp? So what this is relating to is how the IRS assesses Social Security tax. That's what the blocker is when you have additional or high earning salaried roles. So really the savings opportunity is just on that Medicare portion, which is that 3%. Is there an advantage? Sometimes that 3% can still add up to be a substantial number. I've seen it where the savings potential with a high earner could still end up being upwards of 10 grand, where it still outweighs the cost of the additional compliance. So your situation, the circumstances of your situation need to be considered. What is the savings potential? The S Corp, if you don't have like 401k matching through your traditional employer, your S Corp can do 401k profit sharing contributions. Those become a deduction for your business. If you're looking to exit your full-time role and you want to start creating history, financial statements, maybe you're going to do a small business loan as soon as you exit your full-time role. Maybe there are advantages to having the tax history and the financial statements for the separate S Corp. Every situation is unique. It's worth a conversation, but if savings are your motivator, they would probably be limited. Is there a general rule of thumb in terms of what revenue is worth to create or worth it to convert to an S Corp? So just some quick clarity on the lingo. So revenue is referring to what you bill your clients directly. So that's money in. Expenses, deductions, write-offs, that's money out. This is what you pay to keep your business running. What's left over from revenue, and then you deduct write-offs, what's left over is profit. And that's what we're concerned with when determining if there's a savings potential with the S Corp. Profit's what you're ultimately taxed on. The IRS doesn't impose a rule for how much profit you need to make to have an S Corp. You can have a loss, you can have $20 million in profit. It doesn't matter. But if you're looking for savings, usually $60,000 in profit is where the savings opportunity is more than the administrative cost that's triggered when you elect S Corp status. So you can truly have an S Corp with any amount of profit, no profit. You can have a loss, you can have W-2 income. There's no barriers there. It's just that if your motivator for electing are savings, it can be limited. So 60,000 of profit could be a good rule of thumb to have the conversation. Mitchell, if I'm just starting out and don't expect to make more than a salary, I would pay myself. Should I wait to do the S Corp? Should I wait to opt for the S Corp when I am making more from the business? So if you're just starting out, usually, it's not always the case, but if you're just starting out, it's typically an indicator of lower profit. Maybe there's one client, you're testing the theory, you don't have full-time commitment to grow the business. So if you're just starting out and the profit's relatively low, maybe you also have a salaried role. This could be an instance where forming an LLC and staying in LLC could be the best option right now. So you don't necessarily have to make the S Corp election in one fell swoop when you're forming your LLC. A lot of folks form and then add the S Corp later. So in your instance, Mitchell, if the business is new, consider what your profit goals are. Are you on track for those profit goals? Do you have another source of income that could impact the savings potential? There's nothing to say you can't do it now. It's just that if you want to save on self-employment tax, the opportunity may not be there with lower profit. Let's see. Being self-employed, I've prioritized tax savings by reducing taxable income. I'm now finding that it's making it difficult to qualify for a home loan. How should self-employed people approach getting a home loan without a cosigner? This is a great question. We've seen this a lot. When you are self-employed and you report on your Schedule C, for whatever reason, it's difficult for proof of income. Even if you've got longstanding history of being self-employed, it's difficult to show proof of income for whatever reason. Salaried income, W-2 income weighs more in the eyes of a lender. I don't think it's always the case, but most often we've seen that. First of all, anonymous attendee, you're doing the best and right thing. The best advice anyone can give you is take advantage of all your eligible deductions to reduce your taxable income. The flip side to this is if you're reducing your income, profits low, you've got eligible deductions, great. You're reducing your taxable profit. Adding the S Corp election is going to require that you put yourself on W-2 salary. And then the S Corp return also generates a form called a K-1. Between the W-2 and the K-1 that shows your remaining business profit, you've now got some more formalized documents that are separate from your personal filings that you can hand off to a lender. Potentially that can help with proof of income. I know the W-2 portion probably will for certain, but the addition of that K-1 can also serve as a complementary form for your W-2. So in this instance, this is a value add for some people where maybe the savings aren't the big motivator for adding S Corp status, but having the proof of income, having the financial statements, having your business more formalized on a separate tax return could be advantageous for a future mortgage. S Corp owners that take reasonable compensation, are distributions recorded on the K-1? If not, how do you make sure the distribution isn't taxed as self-employment tax? Yes, the distributions are recorded on the K-1. The K-1 is going to show your leftover ordinary income. So this is what's left over after all the business write-offs, including your salary. So that profit is going to account for any distributions you took each year. Only when you're under the S Corp, only the portion that's run through the formal payroll process or payroll software is going to have the Social Security and Medicare tax assessed. Oh my gosh, you guys doubled the questions. Okay, I think I need to go faster. Jamie, if you are filing a late S Corp election, can you report 1099 income sent to myself, or does it have to be reported on the Schedule C? Officially, it should be reported on the Schedule C. You may, if you were to do some Google searching or talk to a couple CPAs, they may recommend a way to report it on under the S Corp and back it out of your Schedule C. It's not best practice. The IRS doesn't like it. But just like full transparency, you may hear of people hacking their way into doing it. Here's what the issue or the risk is. Prior to the S Corp election, if you were receiving income to yourself or to your Social Security number, and then you report it on the S Corp return under that LLC EIN, you could create matching issues. So in the eyes of the IRS, some income was designated to you as an individual, and then you don't report it there, and then it gets reported on the S Corp return. So what could happen in this instance is maybe the IRS flags that there's a mismatch where your income is reported, and they could, issue a notice. They could probably reassess your tax bill. So that's the risk there. It is best practice, and it is actually correct that for the period before your S Corp existed, the income gets reported where it was assigned on the 1099. So if it was assigned to your Social Security number, it would go on Schedule C. If it was assigned to the EIN with the S Corp election, it can be allocated under the S Corp. Robert's asking, how do you split this year's income if you want to do a late sub-S election? So there's kind of a couple paths here. If you have an LLC already, the LLC formation date dictates how far back you can add the S Corp election. So Robert, if you had an LLC that was formed at the end of 2024, technically you could file a late election to January 1st and have all of 2025 covered under the S Corp election. If you are forming your LLC today, let's say California approves it July 30th, the soonest you can elect S Corp status is today, July 30th. So in that instance, you're creating split year activity, where the front half of your year is probably reported on your personal tax return on Schedule C. The income was allocated to you as an individual. And then the rest of the year, from the formation date of the LLC to December, that can be reported under the S Corp return. So you're splitting a full year of business activity on two separate tax forms. Then going forward, everything would be under one. In terms of bookkeeping, so what does that mean? If you got an Excel spreadsheet or like QuickBooks, you would just like put a cutoff date. July 30th was the last date of me operating as a sole proprietor. And that front half would be your profit and loss statement to get reported on your Schedule C. And then the second half, really the books start from scratch when you form an S Corp. And so the second half of the year would be, relied on a separate QuickBooks file or the supportive collective to generate the S Corp tax reporting information. For a California resident, it might be worth it if we elect pass-through entity, but deadline is already passed. Okay, so this question is related to PTET, the pass-through entity tax election. This is something that was created as a workaround to the state and local tax cap. $10,000. Previously, there was no cap where people who itemized could deduct all their state and local taxes, and generally was a more favorable result with refunds. Then in 2017, the Tax Cuts and Jobs Act capped that limit at $10,000. So it was highly unfavorable for people in high income states like California and New York. What the pass-through entity tax election does is it's a workaround for people who have pass-through businesses like a partnership or an S Corp to elect into this process that lets them essentially deduct state tax through the business level. For the 2025 year, the election has passed. You had to have made an initial payment by June 15th, I believe, which means you would just make the election next year. So for 2025, unfortunately, the pass-through entity tax election is gone. However, with the changes with the most recent tax bill, the SALT cap is lifted from 10,000 to 40,000, and it's effective for 2025. So if you missed that PTET election in California, there could still be an opportunity to where maybe it wasn't going to provide as much value as it might have been before this bill was passed. So it is too late for this year. Silver lining, the new tax bill is adjusting that SALT cap from 10,000 to 40,000. And that can help provide some relief on that front. Does a spouse W-2 impact the threshold? So I think this has to do with I think you're asking about the Social Security cap or self-employment income. So does your spouse's income impact anything? The answer is no. Social Security and Medicare tax are assessed per individual. So if you got self-employment income and your spouse's W-2 income is on the side, that's completely separate in determining if there's a savings potential with an S Corp. We're coming up on time. We've got 28 questions left. I think I can stay 10 over. So if you've got time, we'll continue to record. We'll continue to answer some questions. And the questions we don't get to, we've got a plan in place to make sure you get answers. They'll also be posted to YouTube. So hang on if you can. We'll keep going. And if we don't catch you, you can catch the recording on YouTube after this. All right, so let's move on. So John's asking, I am at work and trying to listen. Oh, yes, John, we'll send you a recording. No worries. You can hop off and go back to work. Robert, don't you lose that portion of the QBI deduction for income that is attributed to salary? Robert's asking, so there's QBI deduction. This is that 20% deduction that's allowed for small business owners. Qualified businesses can deduct 20% of their business profit on their personal return. The calculation is nuanced. There are some nuances. There are thresholds to consider when you switch from being a single member LLC to an S Corp. It's definitely something to consider. Let me get more information on how that impacts it. But the short answer is yes, Robert, your salary coming out of the S Corp can put some caps or limits on the QBI deduction. Charles is asking, in the example with the solopreneur making $160 in profit, What if the S Corp has 1 million in profit? I pay myself $100,000 salary, 60 distribution, and the remainder sits in my S Corp business bank account. Let's see. Does my business still pay taxes on the profit that isn't distributed? Okay, so this question is around whether or not you make $1 million in profit in a year. Any profit earned in a year is considered taxable income, and you will pay income tax whether you take a distribution or not. So it's earned income, it's earned profit within that year. Your reasonable salary when you're a high earner tends to be higher, so you're probably going to max out the Social Security limit. And then distributions, whether it's distributions in the full extent of your profit or only $60,000, the $60,000 distribution would still get reported on your K-1, but so would that $1 million in profit. So you'll pay tax on that 1 million no matter what. The best things you can do is take advantage of write-offs. Are you maxing out 401k matching to deduct your taxable profit, or I'm sorry, to deduct that matching profit sharing contribution? But high level, you will pay tax on any earned profit in the year you earn it. Is North Carolina friendly to S Corp? Well, off the top of my head, it's not one of the states that has a big red flag with a state level S Corp tax. Two things to consider: what are the annual fees to keep your LLC in place? And then what's the S Corp level tax imposed in North Carolina? We can get back to you on that one. John's asking, can you start an LLC and convert to an S Corp? If so, is there a time limit to the conversion option? Yes, so anytime somebody has an S Corp, they started out as a legal structure first, and the legal structure continues to exist even when you elect S Corp status. So at the state level, you can form an LLC, it can be a stock corporation, PLLC. All of these are the legal structures and the legal foundation that the S Corp election gets layered on top of. So you do exist as both. I like to call this out. If you were to go to like certain business formation websites and you click to scroll and see, form an S Corp, and you click that button, what's actually happening is they are forming a legal structure for you first. Typically, it's a C Corp, a stock corporation, and simultaneously filing the S Corp election at the same time. So even in the instance where it appears that you're just clicking a button to form an S Corp, it's still a two-step process where the LLC or stock corporation is formed first, and then they add the S Corp election for you. In terms of timing, you can form the LLC, and if you don't make it to the timely S Corp election deadline, you can follow the IRS's late relief process. The rule for filing an S Corp election timely is within 2.5 months of the desired effective date. So for 2025, if you wanted your S Corp effective January 1st, you would need to make the election by March 15th. If you formed your LLC today, July 30th, it would be September 15th or September 30th, 2.5 months from today. In the instance that you file after that 2.5 months, the IRS does have a late relief process that you can follow. Kathy's asking, what if you have multiple businesses, one that pays the reasonable salary and carries the majority of the revenue, another that is a subconsultant to the main company and is a single member LLC, largely break-even loss generator? So I think, Kathy, what you're describing is maybe a holding company situation. The value of a holding company greatly depends on the nature of your business. So sometimes tiered entity structures can create more complexity, more compliance, than they create tax advantage. So sometimes it just creates layers of filing instead of changing the outcome of your tax bill. So it probably depends on how your business is set up. Sometimes it's advantageous depending on the nature of the work. Are there other business partners involved or not? For the members that we support, solopreneurs, it's service-based. Even if it's multiple businesses, sometimes the tiered entity structure just creates a more sophisticated tax profile than providing an actual tax advantage. It doesn't unlock new deductions, but but that may be a question for a more traditional accountant that deals with holding companies and tiered structures. Collective is built for, single owned, single entity layers, but it greatly depends. Where can you find whether your state is favorable to S Corp or not? Tammy's asking. A quick Google search, just see what's the S Corp tax rate in my state. The ones that we flag here at Collective, New York City, if you live within the 5 boroughs of New York City, the city assesses an additional almost 9% tax on S Corp profits. And that's in addition to the federal, state level regular income tax. So it's like a new tax that's triggered if you live within New York City and have New York City income. Another example, maybe in no income tax states like Tennessee, if you operate as a sole proprietor or a single member LLC, there isn't an entity level tax assessed and you don't pay state level income tax. But once you add an S Corp election, it does trigger a tax. So in some instances, it's better to stay with no legal entity or single member LLC. Quick Google search of what's the state level S Corp tax for my state could give you an indicator. Annalise, I'm a California-based psychologist, and when I went online with Collective, it looked like my required professional tax structure isn't something you're able to support. Is this correct? Annalise, yes. So California, every state has their own rules for how you set up a business, particularly when you have a state-issued license. So some states have what's called a professional LLC, where it's a special type of LLC designated for people with a board state-issued license. Every state determines whether or not a PLLC exists in their offerings. Some states may have a professional corporation like you, Annalise. California doesn't have PLLCs. They only have professional corporations. Then to make it more sophisticated, every state may or may not have these options. And then by state, it depends on your particular license. If you're required to have a PLLC or professional corp, some states say you may have one, or you can have LLC or PLLC. So it's a little bit confusing to determine the requirements for how you set up. But in California specifically, there's only professional corporations for licensed professionals. And at this time, Collective can't support legal corporations, even if they add the S Corp election. So Annalise, we can chat if you want to understand more, but there are some things that are out of scope for Collective right now. C Corp Foundation as the entity level is one of them, which is why we can't support licensed professionals in California right now. Asia's asking, what are the penalties if an S Corp has not filed taxes since the designation was granted? Example, 2022 formation date with an S Corp designation. So if you've elected S Corp status in 2022, and it was effective in 2022, there's probably 2 years of unfiled business tax returns. I would expect you'd have some notices by now. I can't remember the penalties for failure to file off the top of my head, but it does have to do with how many K1s are associated. So how many owners are in your S Corp? It could be something like $250 per month of an unfiled K1 per owner. What happens there is you want to file as soon as possible, and then this S Corp return flows through to your individual return. So you may have to amend your personal return or file those as well, which may have their own late filing underpayment penalties assessed. Get them filed as soon as possible because there may be an impact to your personal returns as well. Melissa, can I layer S Corp on a Corp instead of an LLC? Yes. C Corps, there are certain eligible owners. A C Corp is considered an eligible owner of an LLC or of an S Corp. So if you form a C corporation, you can add the S Corp election. And I'm going to do one more and we're going to hop off and then we'll continue to answer these questions and post them to YouTube after. So if we didn't get to yours, there's 20 left. Hang tight because we'll make sure we get you answers. This last one is about California. So converted from an LLC to an S Corp in November 2022, required for certain licensing. I'm a high-risk business, so I want to keep my corporation separate from my personal liabilities. I haven't had any profits yet, but I have invested all earnings into growing my primary service-related business. I also have a seller's permit and run a low profit retail store. Okay, so it sounds like this person's got two separate business activities. Generally, if the business activities are different enough, you want to report them separately. So one, if this is the S Corp with a service-based business, regardless of profit, you've elected S Corp, you're now on the hook for the S Corp compliance. Whether there's profit or not, you do need to file an annual business tax return, make sure you've got clean books. If there's no money and you're not taking distributions, you may not have that reasonable salary requirement yet, but you do have the filing obligation. So just make sure there's a plan in place. If you haven't already, that short period S Corp return for 2024 would have been due. The LLC existing checks the box for liability protection, depending on the nature of your business. Some people supplement with small business insurance. And then separately, if you're running a retail store, again, that would be like, sole proprietor, separate LLC, separately reported for tax purposes. And we're going to call it there. We've got 93 people still on. Thank you for hanging on. Thank you for extending your time with us. 23 questions left. So we will record these and post them on YouTube. No questions unanswered. Stay tuned for more webinar topics. These are free. It's a great opportunity to ask questions. Again, feel free to book time with one of our advisors to see if Collective's the right fit for you. And we'll see you next time. Thank you.